You scan a QR code, tap your PIN, and somehow money moves in seconds. But here's the crazy part. Your money usually doesn't teleport directly from your phone to the shop. It travels through a hidden digital highway. In this video, you are shown two invisible journeys. First, how UPI moves money so fast, and second, how card payments use a different playbook with authorization, clearing, and settlement. By the end, you'll never look at a payment screen the same way again. Let's start with UPI. UPI stands for Unified Payments Interface. It lets you use a UPI app to send or receive money from participating bank accounts in real time. NPCI describes UPI as a system that allows multiple bank accounts to be linked into one UPI app and supports instant payments. Now imagine you're at a tea stall. You scan the merchant's QR code. That QR code tells your app who should get paid. You enter the amount, or sometimes it is already filled in, and confirm with your UPI PIN. Your app then sends a payment request through the UPI system to your bank. If your bank approves, your account is debited, and the beneficiary bank is instructed to credit the receiver. The reason UPI feels magical is that it is designed for real-time payments. The app is the front door. Your bank is the account owner. And NPCI provides the switching infrastructure that helps route the transaction between participating banks. NPCI's official UPI page says the system enables immediate money transfer through a mobile device around the clock. So when you see payment successful, the system has already checked your bank account, validated the instruction, and pushed the transaction through the network in seconds. That does not mean every problem is impossible. RBI's customer-facing guidance notes that if a UPI account is debited, but the beneficiary is not credited, there are prescribed auto-reversal timelines and compensation rules for delays. Think of UPI like a super-fast digital traffic police system. Your app says, "This person wants to pay." The network says, "Route this to the correct banks." Your bank says, "Yes, funds are available." The receiving bank says, "Credit received." And all of that happens so quickly that it feels like one single click. UPI is fast, but card payments are even more interesting because your money may be approved now and settled later. When you tap, swipe, or enter your card online, the payment usually goes through a chain. It starts with the merchant and their payment terminal or website. That request goes to the acquiring bank or payment processor serving the merchant. Then it goes through the card network, like Visa, MasterCard, or RuPay, and reaches the issuing bank, which is the bank that gave you the card. The issuer decides whether to approve or decline. Visa and MasterCard both describe card processing using the core stages of authorization, clearing, and settlement. So when you tap your card at a store, the first big moment is authorization. That is the yes or no decision. Is the card valid? Is there enough balance or credit? Does anything look suspicious? If approved, the merchant gets the green signal. Here's the part most people never see. Authorization is not always the final movement of money. After approval, card systems typically go into clearing and settlement. MasterCard's official explanation says its switching services include those three core activities: authorization, clearing, and settlement. Authorization checks and reserves approval. Clearing exchanges the transaction details. Settlement is when banks actually transfer the final funds between themselves. That is why a card payment can be approved in seconds at the counter, even though final bank-to-bank settlement happens through the network's later processing cycle. So UPI and cards may both feel instant to you, but behind the curtain, they work differently. UPI is built around direct account-based, real-time payment messaging between participating banks. NPCI's UPI system is specifically designed for instant bank-linked transfers. Cards depend on the merchant side, acquirers, card networks, issuer approval, and then later clearing and settlement. That extra structure is one reason cards remain powerful for global acceptance, chargeback processes, and credit-based spending. So why do payments sometimes fail? A few common reasons. Your bank may be temporarily unavailable, the merchant endpoint may not confirm in time, the receiving side may lag, or the network may flag the transaction for risk checks. RBI has official turnaround rules for failed UPI and card-related complaints because payment systems can face temporary failures even when designed for speed. So the next time a payment succeeds in 2 seconds, remember what just happened. Your phone, app, merchant, networks, and banks all coordinated almost instantly. That tiny green tick on your screen is actually the final frame of a massive digital choreography. If you love hidden tech systems explained simply, subscribe for more videos on the internet, payments, data, and the invisible machines behind everyday life.